Here's a number that should stop you cold. 6.5 million. That's how many burgers McDonald's sells every single day in the United States alone. Every single day. And yet, if you sat down with McDonald's actual financial statements and covered up the company name, you would never in a million years guess you were looking at a fast food restaurant. You'd think you were reading the books of one of the largest real estate empires on the planet. Because that's exactly what McDonald's is. And by the time this video is over, you're going to understand the business model that most people, including most investors, completely miss. Let's start with something that happened in 2008. The financial crisis had just detonated across the American economy. Banks were collapsing. Unemployment was spiking. Families were losing their homes. The stock market was in free fall. It was, by almost every measure, the worst economic disaster since the Great Depression. And in the middle of all of that chaos, McDonald's did something remarkable. It had one of its best years ever. Same-store sales kept climbing. The company opened 600 new locations. Its stock was one of only 2 in the entire Dow Jones Industrial Average that actually went up that year. The other one was Walmart. Everyone else was drowning. McDonald's was buying beachfront property. Literally. To understand why, you need to forget everything you think you know about what McDonald's actually sells. Most people assume McDonald's makes its money the obvious way. You walk in, you order a Big Mac and some fries, they hand it over, you pay, they profit. Simple. But that's not how it works. Not even close. The burgers are almost beside the point. They're the front door, not the business. The real business is something far older, far more stable, and far more profitable than fast food has ever been. The real business is land. Here's how the whole thing is actually structured. About 95% of McDonald's locations around the world are not owned or operated by McDonald's, the corporation. They're run by franchisees, independent business owners who pay for the right to operate under the Golden Arches. This is not unusual. Burger King does it, Subway does it. Most major fast food chains operate on some version of a franchise model. But McDonald's does something that almost nobody else does. And this one difference is what separates it from every other chain on Earth. When someone wants to open a McDonald's doesn't just hand them a license and wish them luck. McDonald's goes out and buys the land. Then it builds or leases the building. And then it turns around and leases that property to the franchisee at a premium. The franchisee is not just paying for the right to sell Big Macs, they are paying rent every single month to McDonald's for the land under their own restaurant. Think about what that means for a second. McDonald's is not in the business of hoping customers show up and order food. It is in the business of collecting rent checks. Whether the drive-through line is out the door or the restaurant is having a slow week, that rent check is coming. It is contractually guaranteed. That is a completely different business than fast food, and it is a dramatically better one. Now, let's talk about the numbers, because this is where it gets genuinely staggering. In 2019, a normal non-crisis year, McDonald's brought in about $11.6 billion in franchise-related revenue. Of that, $7.5 billion, roughly 64%, came not from royalties on food sales, but from rent, from property, from land. The food was almost secondary. And sitting on its balance sheet was approximately $39 billion in property and equipment before depreciation. That would technically make it the 5th largest real estate holder in the world by total assets. Not the 5th largest fast food company, the 5th largest real estate holder on the entire planet. So how does McDonald's decide where to buy? This is where it gets interesting. The company has essentially cracked the code on commercial real estate location science. It is not guessing. It is not just looking for busy streets. The ideal spot sits at the intersection of 2 high-traffic roads, on whichever corner has the most parking. The surrounding area needs traffic lights, which slow cars down and create natural stopping points. The target footprint is around 50,000 square feet of total land, with roughly 4,500 square feet of actual building. And because McDonald's has bought and sold so much property over so many decades, it can negotiate long-term fixed-rate mortgages that most smaller buyers simply cannot access. Once the property is secured, a franchisee comes in and signs what's called a franchise agreement. This document is extraordinarily detailed. It covers how the food is cooked, what temperature the fries are served at, which suppliers can be used, what the hours of operation are. The franchisee typically puts up between $1 and $2 million up front, including a one-time fee of $45,000 just to get in the door, plus an ongoing royalty of around 4% of monthly gross sales. These contracts typically run 20 years, and here's the detail that ties the whole thing together. The contract specifies that the restaurant must operate at that specific address, the address that McDonald's owns. The franchisee cannot pick up and move. They cannot renegotiate their way out of the location. They are a tenant, locked in, paying above-market rent to their landlord, who also happens to be their franchisor.
And what does above market look like? Studies have found that the average franchise restaurant pays somewhere between 6 and 10% of its sales in rent to its property owner. McDonald's franchisees typically pay between 8.5% and 15%. That gap is not an accident. It is the model. Now, you might be wondering, if the terms are this demanding, why does anyone agree to them? The answer is because despite the costs, a McDonald's franchise is considered one of the safest investments in American business.
The average McDonald's location in the United States generates around $2.7 million in annual sales. The average franchisee takes home around $150,000 in profit after all expenses. That's not life-changing money for someone who put in $1 million up front, but the failure rate is remarkably low. And that's precisely because McDonald's has already done the hard work. The location has been vetted. The brand is established. The training through what McDonald's calls Hamburger University prepares franchisees for almost every operational challenge they'll face. You are not starting a business. You are buying into a system that has already been proven to work in tens of thousands of locations around the world. But the deepest advantage of the real estate model isn't the rent revenue. It's what that model does to McDonald's during a crisis. Think back to 2008. When the recession hit and property values collapsed, McDonald's did not panic. It went shopping. Distressed properties were suddenly available at discounted prices, and McDonald's, sitting on billions of dollars in existing real estate and with the balance sheet to back long-term fixed-rate loans, moved in. While other companies were retreating, McDonald's was expanding its land holdings at a discount.
And during the pandemic in 2020, when restaurants across the country were shuttered and revenues evaporated overnight, franchisees were still contractually required to pay a minimum amount of rent to McDonald's, regardless of how many customers came through the door. The risk had been outsourced. The corporation was insulated. This is not a side effect of the business model. It is the entire point of it.
There's one more layer to this story that rarely gets discussed, and it involves taxes. American tax law has for decades offered significant deductions for property depreciation, meaning companies can report the declining book value of their buildings as a loss, even while those same properties are often increasing in real market value. For McDonald's, this creates a situation where it is collecting billions in rent, sitting on tens of billions in appreciating land, and simultaneously booking depreciation deductions that reduce its taxable income. The real estate model is not just a revenue engine, it is a tax strategy.
Which raises a question that a group of investors actually put to McDonald's management back in 2015. If the real estate is this valuable and this separate from the burger business, why not spin it off into its own company, a real estate investment trust that would be pure property, no fries attached? The math was compelling. A standalone McDonald's REIT would have been one of the most stable and profitable real estate companies in the country. But McDonald's said no. Its position was that the two businesses are inseparable, that the efficiency of the model comes precisely from controlling both the brand and the land simultaneously, that you cannot collect above-market rent if you do not also control the franchise agreement that locks the tenant in. It is one machine, not two.
So the next time you pull into a McDonald's drive-thru and order a coffee for $1.50, take a second to look at the ground under that restaurant. McDonald's probably owns it, and that ground, not the coffee, not the burger, not the Happy Meal, is the real product. The food is just the reason people show up. The land is why the company never goes away.